And the topic this time is really looking at how essentially are we going to sort of deal with this whole question about volatility, which is a hot political topic, as we all know. There are a number of aspects to this. Is it a natural phenomenon of pressures in supply and demand? Arguably, if an exchange is clean, is running efficiently, has a really reliable price formation process, and this is my first question to the panelists, if that is the case, do we just have to learn to live with volatility and stop complaining about it, or stop trying to flatline it and just accept that if that's what the pricing truth is telling us, we've got to live with it and manage it? What do you think?
Well, I have the case of our exchange. Our exchange was founded more than 100 years ago, and when I started working there, I tried to read the memories and the books of the old days. And I found that volatility in wheat, and corn, and linum were higher than today, because the lack of a mechanism to transfer the demand and supply in the time and showing the cost of carry made they have a shortage of production that were tremendous in that times. So I think volatility is now and will be there for a long time. We have to manage the volatility with risk managed procedures. We have to learn to deal with politicians that won't like volatility never. I think that there is a problem for these changes, because volatility is making our margins become higher and higher. We are having the double of the margin for soybean, for example, than 10 years ago. And this fact makes some volume moves out from the exchange to the OTC environment. And in our case, in Argentina, this OTC environment, I think, is not safe enough, because risk management procedure of companies that is trading OTC in soybeans, corn, and wheat, I think they are not sophisticated methods, and they have no possibility to measure how many times a farmer or a pool of farmers has sold their crop. So there is a lot of risk in the high volume we are having in the OTC environment in Argentina.
It's interesting you say that, because clearly that's once again the economic case being made for the end user's point of view. If margins go up too much, then we might decide to go elsewhere. Sorry, Samir, do you have it?
Yeah. I think the answer is sort of a bit of both, in the sense that, one, there needs to be an acceptance that volatility is here to stay. You know, it's a fundamental reflection of what happened. It's an economic reality today. Having said that, I don't think it's appropriate for exchanges to take the view that because it's here to stay, we just accept it. And I think there are several things that the exchanges can do and are doing worldwide in terms of managing and bringing a sense to that volatility. In our own experience, for example, as an exchange that hasn't been around for as long as my sort of colleagues' exchange has been, but the limited experience we've had shows us that there are a few parameters that if you work within and tweak on an ongoing basis, that you can start to address the issue of volatility. And I'll just place for consideration some of those things. So one of the things we found is obviously not the most important thing is having the right risk management capability. So the right margining, sophisticated, reasonably elaborate margining capability will address some of the volatility issues. So I think that is an ongoing exercise. That's a whole area that constantly develops and evolves. So there has to be an eye on the ball as far as risk management capabilities of exchanges are concerned. Another aspect which again has been looked at, but not necessarily in the context of volatility, is trading times. So how long the market is open. And in our experience, an element of continuous trading does reduce volatility significantly. Because you just give ample opportunity for investors and traders to participate in the same market rather than to have positions move around in fragmented liquidity pools, which then creates rise of liquidity. So an effort to offer continuous trading is, I think, an element, and of course that has costs associated, and that has implications on the trading fraternity, but that is an element to be looked at and considered. Another element just to throw into the discussion pot is things like the product portfolio, for example, because traders, investors don't just do one contract or one asset class, they do multiple. If the exchange can offer a product portfolio that meets most of their requirements, then it is more efficient capital-wise for them to stick to a particular platform and meet the requirements. Of course, the clearing firms, do that in any case. But even from an exchange's perspective, I think the ability to look at a product portfolio and try and meet the requirements of participants is an important element of addressing the issue of volatility. So it has a few flavors, is my point. So I don't think it's as easy as saying let's just accept it. It's an ongoing effort to constantly look at that.
Okay, Aman.
Yes, as far as I'm concerned, the three levels that you have to deal with it. One is the PR, political advocacy level. Then there's the operational level of the exchange. And then something that I think is a bit newer is the way that you deal with your brokers. It's the PR, policy advocacy level. I don't think any exchange can now afford to define itself as something like a technocratic institution. We're right in the middle of the political debate. You have to play your role. You have to sponsor studies. You have to be there, not just in the capital, but also at the large international gatherings. If not, you can be hit hard by the G20. I know that what Sarkozy says, for example, has an impact on the way that Indian policymakers think. So as an exchange, you have to be there at that political level. Operational level, you better know what you're doing. We have real-time margining. We run a span file many times each day, intraday margining. Many exchanges still work with a much slower margining model, getting the money only the next day. You better know what you're doing, okay? Because markets move very fast. We've had 20% price movements of silver in one day. No problem for us, but yeah, is your system up to that? Similarly, operationally, is your technology up to date? You get spikes in trading volumes driven by algos and the like. You better know what can come to you, and you better have the systems in place to shut down algos that go haywire, because some of them will. In times of high volatility, I wouldn't trust some of the softwares out there. Interaction with brokers, that's an interesting one, because if you had asked me 4 years ago, I would say brokers is let the buyer beware. I now actually think you have to take more of a responsibility as an exchange for the way that your brokers operate. Again, at the same levels as we operate, one is the margining, the other is the technology. Margining, we force brokers to keep segregated accounts, we force gross margining. So in principle, the money is there, but you've seen after men, that's not always true. So I think that one of the new developments will be that clients will be given the choice to park their money directly with the clearinghouse. I think that would be actually a very good thing to do. We need to develop technology for that, but I think that will be coming. Tough luck for the brokers who, their business model was in the past based on making money on the back of clients' money. The other thing is technology. One example in India, we had one large broker, very large, growing as fast as we were growing, and basically spending a fraction of what we were spending on technology. And we've known that they weren't spending enough on technology. They regularly had problems. Their trade locked up. We knew it was going wrong. The only thing that we did was tell them, look, this is how much we spent when we were doing the type of volumes that you are doing now. But this was just, if you want, a moral level. I must say that now they have invested, so now they're okay. But for about 2 years, every few weeks something went wrong. And this was a very, very big broker. Luckily doing only prop trading. But you just need, they were really on the balance. I mean, if something had gone wrong, they would have gone belly up with probably systemic consequences for us. With hindsight, we probably should have been tougher with them rather than just relying on, if you want, moral persuasion.
Let me ask you this question, because you've raised it about what kind of controls do we have in place to deal with the consequences of increased volatility. I mean, you both have touched on this, and let me just ask each of you as an exchange. I mean, there are a whole lot of options. I mean, you've interestingly mentioned stay open longer, because actually you kind of may smooth out the spikes a bit. Others would say, no, we must have trading halts and all sorts of other things. What have you got on your market to do with volatility?
Well, in our exchange, we have put in work, since we launched financial futures 10 years ago, a risk management software to make intraday margin calls that had worked very well. Our exchange original trade grains futures, and usually we post margins in T+1. But when in 2002 we started to trade FX futures and banks become trading in raw FX, and the central bank also become a member, we have to work a lot in the risk management softwares and procedures. And also having a legal framework of segregate accounts and having the force in the clearinghouse to liquidate the collaterals if we have a default. That this is quite a big problem in Argentina, because the bankruptcy law doesn't allow that. But we made a trusty legal framework that allow us to liquidate all the collaterals for the defaulter. So the basics is the same in any exchange. Segregated accounts, a legal framework that allows the CCP to liquidate collaterals and post it in the market, and a good software to make intraday margin calls.
Thanks. I think some of the things I talked about before, which is having the most capital efficient capability for managing risk and margin management will lead to more capital. The more efficient the capital is deployed, the more adequate and appropriate capital you have set aside in own account and segregated account for the different products you trade in. So I think that is I think a key feature. We, as I mentioned earlier, we constantly look at trading times and see whether that makes sense. Third is product portfolio, which I've mentioned again in the context of being more capital efficient. And the fourth, interestingly, is also, which is, I think a lot more work needs to be done both at our end as well as exchanges, especially in emerging markets, I think, is the whole sort of conversation around research and information. And the role that exchanges have to play in that context. That goes back to, I think, your point around policy, sort of the role that exchanges play in the policy conversation. I mean, one can say that in today's highly connected world and financial markets, that information is very easily available, and there isn't any information arbitrage. But the reality is far from it, especially as you go down, niche products, niche contracts, emerging markets. You will see a sort of information dissemination and information fragmentation that happens, and that to me creates in exceptionally volatile times. It is at that moment when a dry up of information leads to even increased volatility. And that's where I think the exchanges do need to play a role in the context of being a facilitator of providing neutral, independent research information, or just building up, I guess, a set of fabric in the marketplace which facilitates free flow of information and research. And I think that piece, obviously in more developed markets, it may not be the case, but I still think that even in developed markets, it's equally applicable.
I'm not going to ask you, Lam, because you've mentioned some of the things that you do, if that's all right. What I'd rather do is just focus on that other one that none of them are mentioned, which is this whole debate about position management and position limits. So in the US, there is a very strong drive to say, we're not quite sure we understand what you mean over there in Europe about position management, but we're a great believer in position limits, and as we know, the CFTC has run into a bit of trouble judicially. We'll wait to see. I don't know whether there's been an answer yet, but there's been a challenge to their ability to impose position limits without having done a major cost-benefit analysis of its consequences for the market. IOSCO has taken the view that it should be position management, including position limits, and that seems to be the line that the Europeans are taking. I just want to turn to each of the exchanges and say, against the background of that debate, where does your exchange sit? This is where we have an excessive speculative position that you perceive to be disturbing the price formation process in a way that is not economically viable, unacceptable. Sorry.
Well, I think position limits are good. Mm-hmm. And in the dollar futures, we have to put a strong position limits, and the Central Bank of Argentina are obliged to complement with these position limits. And that was one of the key that we get trust of our clients and the volume grows. But in fact, there is another OTC bilateral NDF trading that are not reached by position limits. And I think position limits are good, but I don't think it is possible to be sure that are working, because it's very difficult to measure the position of participants that are trading in a lot of places and a lot of exchanges, and also in many countries. Mm. So I think the step ahead to put in a trade repository is a good measure, but I am not very optimistic about in which times we could see a full trade repository working, and we can have integrity of the positions of all the participants.
Okay. Samir, what do you think?
The jury is out on that topic. It is a very delicate topic, right, in terms of position management and position limits, and it is going to kick up a fair amount of discussion and controversy around it. Based on our experience and just my own thinking on this topic is position management is perhaps a better way to look at it than position limits. Anything that is limiting is always going to have an impact on volatility. The fact that you limit participants, I think the better way to look at it is position management, which is link it up to the ability to put capital, segment the way you look at positions based on participant types. So a constant work on looking at managing the whole aspect of positions by member types, by the ability to put capital behind your trade, and an active consideration such that you maintain a fair market on an ongoing basis is probably where the emphasis should be, okay, at least from our experience.
Basically, don't you want both? I mean, this is a silly argument, isn't it? You want to be able to manage positions, and you want to be able to impose a limit in extreme circumstances.
I agree with that, but what do? You are regulated. So, I did some research back in the mid-90s when investment funds became very important in commodity markets, and I found that actually most investment funds voluntarily limit their positions for the very simple reason they want to get out of their positions. Mm. And if they're too big, they know they will be the target of others. So position management is the way to go. Regulators like hard limits, percentages, and tons, whatever. But whatever it is, I mean, don't overestimate the impact that this will have on volatility, for example. It is simply not as big a problem as some regulators may pretend. Markets are primarily driven by physical fundamental supply and demands. And when you play around with position management, you influence price fluctuations on the margin, but not more than that.
I think part of the worry is, yes, sorry, do you want to say something? Of course.
I also agree that position limits have to deal with manipulations, have to avoid manipulation of the exchange. But I think volatility is caused by supply and demand reasons.
Yeah, I think that's right. I think one of the problems is that we kind of lose sight of the fact that trading on price, pure speculation, is a legitimate use of a free market. And sometimes we get muddled up with speculation and manipulation, and we introduce all these words together in financialization. They actually all mean fundamentally very different things. So financialization, for example, includes speculation, but it also includes financial portfolio management and all sorts of other things, and anti-inflationary hedging and everything else. If you talk about speculation, it's pure position trading, nothing much than that. If you talk about manipulation, that is unlawful, it's illegal, it has to be stopped. I mean, so the trouble is we use these terms, and politicians tend to use these terms as if they're completely interchangeable. But let me pause there. We'll come on to the political side of all of this in a minute. But let me just go around the room and see if there's any questions. Yes, one over there.
I think one of the things that I mean, volatility, I would agree, longer-term volatility is fundamentally driven. I think one of the new things that's come into the market is a higher level of intraday volatility. We're seeing a lot of new players, high-frequency traders, get a lot of flack thrown at them. As far as I'm concerned, trading is a legitimate thing, but it is unbalancing the way that the traditional hedger and his relationship with the market has developed. So a lot of the traditional players are finding the intraday movement almost impossible to deal with. And markets are beginning to behave in ways they haven't done for a while. So the cocoa market a couple of weeks ago dropped 400 sterling, which was about 20-something% of the price, in 5 minutes, and went back up 375 2 minutes later. That type of volatility it's unreasonable because there's nothing to do with fundamentals. There are no fundamentals driven in that. And I think it's the job of the exchanges to try and manage that, the transition between the old order and the new order, and to help its members understand how that flow of money is changing the way that they need to look at markets. It also means, I think, we have to look at potentially new contract structures that guard the value of the hedge against the underlying physical. Because if it's being hit by that type of volatility, I don't think the hedge is as valid as it used to be.
Interesting. This was a fear of, in the early days, the London Metal Exchange, which was essentially a commercially driven marketplace, and they got very worried about the weight of fund business that was beginning to hit that market. And I think they've got an equilibrium going. But is there an issue? Is there a real issue here about proportionality of speculators against real economy market participants?
Well, in our exchange, we have only commercial trading, and obviously we want more speculators. And one of the issues that in Argentina we didn't develop well is the retail investors. But I agree that some high-frequency trading practice could introduce an intraday volatility that is that you have no fundamental reason for that. And I think some exchanges are trying to deal with that. Some exchanges are trying to put fees on orders that are not executed, or maybe you could put a minimum of latency that an order will apply. And I think we will see some of these initiatives in the future, because I don't want in my exchange to have a fall of 20% in 5 minutes, and I think any manager of the exchange wants that.
Okay. Before I just pass on, just one quick point, just for those of you who may know, I mean, in the EU, it's going to be an act of market manipulation to put orders into the market which you have no intention at the time of placing the order in the market of executing whatsoever. It doesn't stop you changing your mind for legitimate commercial reasons afterwards, but if you're putting an order into the market and you have no intention of executing it, that will be deemed to be market manipulation, just as a thought. Difficult to prove, though, but anyway, sorry, Samir.
The point that you raised was absolutely key. I think it is key, and it is a key responsibility for the exchange to ensure participation and diversification in participation. And the way we're dealing with it is to ensure that for different contracts and for different products to have a extremely diversified participation on that contract, which then brings a natural check and balance in terms of intraday volatility. And you cannot solve that problem overnight. It's an ongoing process, but it goes to the heart of the kind of membership structures you offer that encourages different specialized participants to come and become members on the exchange and put their business on the exchange. So it is a very complex topic of constantly trying to ensure that the participation is broad based. So I do acknowledge that responsibility, and I think there is a lot that can be done in that area.
Lamont, do you think it's got slightly skewed as Clive was suggesting here?
Well, algo trading on our market is now 20%. And they started just 2 years ago or so. My understanding is that on CME commodity contracts is in the range of 40%. And algo trading can be very fast. Well, you deal with it in different ways. One thing that we do, like many others, you make people pay for high order-to-trade ratios. They pay relatively little with a good order-to-trade ratio, and you rapidly escalate their payments. At the end of the day, we have one broker who regularly pays those fines. They're happy to put 100 orders for one trade and pay us extra. Okay, can't stop them. But that is one way that you try to avoid that type of wrong market behavior. The other thing, you have to do things that are wrong in principle but right in practice. If you ask me for a theoretical argument, I'm against closing markets. But in practice we do that. When prices hit a certain limit, we close the market for 10 minutes and then we reopen it again. Theoretically this shouldn't work, but in practice we're dealing with people, and it does work. It does cool down markets. Apart from that, there isn't a lot you can do. The unfortunate thing is that you have commercials and you have financial players. Now normally commercials will have difficulties with these big intraday fluctuations, but if they have a proper partnership with the bank, that shouldn't be a problem. The problem is that the banks are not doing their part of the business properly. At the end of the day, if the cocoa price is £400 lower than it should be according to fundamentals, there's money in it for someone. Problem may be that the people for whom the money is there don't have the money to enter into the position. So that is a dysfunctionality between commercial players and the financial sector, which as an exchange you can't really solve.
Okay. Let me turn to the floor again. Any questions for any of our speakers on this so far? Fred.
I just wanted to follow up on Clive's question, because you can tell how we think alike, and maybe I'm showing my age, but I prefer to think it more in terms of showing my experience. But it's the market structure question. And as Clive said, it's not so much the market ups and downs, but it's these big swings that we get in the marketplace. And my question is, has the market structure changed significantly? When I say I show my age, I go back to the days when there were floor traders on the floor of the Chicago Board of Trade or Mercantile Exchange or Life. There were specialists at the New York Stock Exchange or market makers on the options exchange. And it was their job to keep prices in line. Certainly they were incentivized to do that, but that was their job. And it just seems to me that that function has disappeared. Maybe it's because of algorithmic trading. Maybe it's because of lower spreads in the marketplace that this activity is no longer profitable. But my simple question to the people on the panel is there any function in your market? Is there anyone in your market whose job it is to try to keep these price fluctuations in line, to prohibit these dramatic swings that we're getting in the market?
I think that's a really interesting question, because this is about, you can do it by numbers technologically, but if you haven't got a feel for the market, then it's going to go wrong. I mean, would you agree with that? That somehow we've lost a sense of feel about where the market should be, and we're just doing it automatically?
Well, we are a quite teeny exchange, and in agricultural futures we have market makers that are acting actually like Fred tells. They are people that came from the open outcry pit. Maybe they are using some algos to capture Chicago prices and put them on the basis with our local prices. But they have the spirit to do that. And as Christian Sima told in the previous panel, we are happy to tell that we have market makers that are doing that in our exchange. But in the dollar futures, the question is quite different, because we have a lot of intervention of the central bank in the spot market and in the futures market. And when there is a spike in the prices, a sharp movement in the prices, all participants thought that is the central bank trying to send a message. So it usually kills the liquidity and the markets stop trading in this moment. And maybe it was not the central bank doing that, but this is the sentiment of the traders and the exchange.
Very quickly, because I just want to deal with the political issue. So if we could, because I know we're running out of time.
Yeah, I would just echo the role of the market makers to have a very robust market maker program that allows market makers to make those prices just like the old days in the pit, and then hold them to performance standards, and have a very deep partnership with the market makers, and so I think that there's a big role to play in that.
We don't have market makers, but we have 300,000 trade workstations connected to our exchange, and behind many of those are people. So we have huge trading rooms, rooms like this. In India they can fit 500 people, and people throw a keyboard away every 2 weeks, and those are the counterparts of the algos, and that helps to keep markets in check.
Okay. Before we come to just quickly to the political side, any more questions that anyone's got? Okay. This is an interesting one, I think, because politicians always say very loudly and publicly they love the idea of free markets, all that kind of language. And then when markets start to explain or expose marketing truths, pricing truths that are unpopular, don't quite run with politics, you then get rather cynical, populist kind of policies beginning to emerge, and a sort of interventionism in the construct of the market. It may be done through regulators, it may be indirect, but which is almost telling you this is a little bit of price control through the back door maybe, and the price integrity, the price formation process has to be a matter for the exchanges and made up of legitimate economic trades, and the direction of those prices, I think we just have to accept the direction that we get. But I get the feeling that increasingly, and some politicians have a natural concern about this, and others it's just cynical populism round about electioneering time, no names mentioned. Do you have a view on this? Do you find that political pressure is beginning to come down on you, even through regulators?
In Argentina, politicians don't like free markets.
Sorry, right, that was my first mistake.
This is the first. And populism is not to like free markets. Yeah. But the positive side of this is if you show politicians that derivative markets could be a tool for them, you could still operate in, and you could still have good volumes. In dollar futures, we show the central bank that having derivatives to show the price of the FX rate and the price of the implied interest rate in the positions will be good for the economy. And since 2005, central bank became a member and started trading. And actually, the volume of the central bank is less than 5% of the total volume, but the system works very well. In the agricultural futures, government has a conflict with farmers in 2008 because they wanted to raise export taxes. It was a very tough conflict, and farmers won. But after they won, government find another way to raise the taxes, that is not allow exports of wheat and corn. So the internal price go down, and the volume in the futures market goes to zero because supply and demand was destroyed. 2 months ago, we have convinced some parts of the government that they could allow exports of wheat and corn if the buyer has previously buy their grain in the forward market, on the futures market, and they allow that, and the futures began trading again. But we have to be near politicians because they are the threat, and it's better to show them how to use the exchange than to convince the exchange are good. The exchange are goods.
If there's any consolation to you, we're having a similar problem in the EU about politicians. Not all of them, but some of them. Samir.
It's not that relevant a topic in the jurisdiction that our exchange operates. So I'd sort of rather pass this question, but I know that Lamin will have a lot to say given his jurisdiction.
How long do you want, Lamin? Sorry.
No, I'll keep it short.
Minutes.
I think one of the problems is your physical market local or global? And that's a problem not just in India, even in the US. I think much of the problems with the wheat contract was that it's a global contract, which does not necessarily reflect US conditions. Same in India. When you have a futures market, there's a good chance that this will, if you want, import global conditions. And this may not be what politicians want, and this may not be what the local, even some of the local physical players want. The only thing you can do is, as I said, you do your studies, you make sure they are read by some people in power, and you hope for the best. But yeah, India, we've had several contracts closed in the past. Most of them are now again permitted, but the market is still pretty much afraid to start trading those contracts.
Okay. I think that probably brings us to the end of the session. Pretty well on time. I'm getting a nod from the back of the room there. So can I just say a round of applause for our panelists. Thank you very much. Thank you.